Are Africans incapable, or is it just that they can't cooperate like others? Let's be honest. Africa is rich. Gold, oil, cobalt, copper, uranium, fertile land, a young population, you name it. Yet the continent remains poor. So what's going on? Before colonization, Africa had thriving kingdoms, trade networks, scholars, agriculture, and metallurgy. Poverty wasn't the baseline. Extraction created it. European powers didn't arrive to civilize, they came for land and minerals. Borders were drawn to split groups, weaken resistance, and secure export routes. Economies were structured to export raw materials and import finished goods. Independence changed the map, but the plumbing of the economy remained. Sovereignty on paper, dependency in practice. Colonization didn't end, it evolved. Instead of flags and soldiers, the tools became debt, finance, and regulation. After the 1960s, newly independent governments needed capital. Roads, education, healthcare, industry, all required funding. Western governments and institutions offered loans through the IMF and World Bank. The terms seemed harmless: modernization, structural reform, development assistance. But behind the words were rules that reshaped economies. Structural adjustment required cutting social spending, privatizing public assets, removing protective tariffs, liberalizing capital flows, and pegging currencies to foreign powers. Once a country accepted these terms, industrialization became nearly impossible. Domestic industries collapsed under competition from subsidized imports. Public services shrank. Resource exports accelerated to generate foreign exchange for debt repayment. Value left the country twice, once through extraction, again through interest payments. Why debt? Because it's predictable control. If you can't fund your own priorities, you depend on lenders. If you depend on lenders, they decide what matters. National budgets serve creditors before citizens. Debt becomes a leash. Let's break it down. A country exports $2 billion worth of minerals. Foreign companies take most of the profits through ownership stakes, tax exemptions, and transfer pricing. Governments might see 10 to 15% of that revenue. Meanwhile, debt payments exceed what remains. Essentially, nations extract value only to send more value out. The World Bank itself shows that outflows from African countries often exceed inflows once profits and interest are counted. If development were the goal, why structure finance to make capital leave faster than it comes in? Critics blame corruption. Sure, it exists, but not in a vacuum. Corruption thrives because foreign firms offer bribes, offshore havens protect stolen wealth, and Western banks accept illicit transfers. Weak institutions make it easier to siphon wealth and control governments. Internal dysfunction becomes part of the system, not an accident. Global finance rewards obedience. Follow IMF conditions and you get credit access, favorable ratings, aid. Resist and you risk sanctions, capital flight, or destabilization. A rational leader, even one who wants development, faces a choice: comply and maintain power, or resist and risk removal. This isn't conspiracy, it's political economy. Take cobalt, for example. Miners earn a few dollars a day. Governments collect minimal royalties because companies negotiate exemptions to attract investment. Raw ore ships abroad for refining, which multiplies its value by 5 to 10x, but all that value accrues elsewhere. Western consumers enjoy cheap electronics because African wealth is extracted quietly. Why doesn't Africa industrialize? Because the global economy isn't neutral. Trade agreements encouraged primary exports over manufacturing. Currency pegs like the CFA franc make exports uncompetitive. Attempts at nationalization or domestic processing, like Ghana's cocoa or Zambia's copper, faced retaliation, commodity price manipulation, withdrawal of investment, IMF pressure, capital flight. A system that punishes climbing the value chain isn't accidental. Internal challenges amplify the problem. Brain drain pulls skilled labor away.
Education systems remain underfunded. Subsidies favor elites tied to extraction. Regional trade remains fragmented. Leaders rely on resource extraction for quick revenue because election cycles reward immediacy over long-term growth. Citizens blame local leaders, rarely seeing the structural incentives behind their choices. Internal decay reinforces external control. Who benefits from Africa remaining at the bottom of the value chain? Simple. Countries and corporations dependent on cheap minerals, cheap labor, and resource access. Industrial economies need cobalt for batteries, oil for energy, rare earth minerals for tech. If Africa refined its own materials and manufactured finished goods, global prices would rise. Corporations would lose profits. Shareholders would demand cheaper supply. Poverty becomes an unspoken subsidy for the world economy. Now imagine Africa fully industrialized. Local refining, domestic manufacturing, debt-free budgets reinvested internally. Who loses? Multi-billion-dollar corporations, nations relying on cheap imports, financial institutions wielding influence through lending. The system accustomed to African poverty would face higher costs. That's why the system isn't neutral, it's profitable. So, is Africa poor because Africans are incapable, or because poverty is engineered for global gain? Africa wasn't born poor. Africa was made poor. And the system that created this poverty continues, not through guns, but through contracts, loans, currency regimes, corporate exemptions, and selective enforcement. Those living above the resources pay the cost. Those who benefit remain far away. That is the inconvenient truth.